Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome back to Tax Smarts Unlocked. I'm David Robson, your resident tax strategist with a passion for turning headaches into aha moments. Today's mission: understanding the tax implications of charitable contributions, how to give back while saving big. If you've ever written a generous check and wondered, did that actually lower my tax bill? This episode is for you. We'll cover who really gets a deduction, how to pick the right charities, why appreciated assets often beat cash, the power of donor-advised funds, the magic of qualified charitable distributions in retirement, critical paperwork rules, and smart timing so your gift lands in the right tax year. I'll also tackle small business twists, state credit traps, and real case studies. Let's make generosity and tax efficiency best friends. First, who actually gets a tax break? Charitable gifts lower taxes only if you itemize deductions instead of taking the standard deduction. For 2025, the standard deduction was roughly $15,000 for single filers and $30,000 for married filing jointly, with head of household at about $22,500. If your mortgage interest, state and local taxes, charitable gifts, and other itemizable items don't exceed that threshold, your donation won't produce an additional federal deduction. The $10,000 cap on state and local tax, SALT deductions through 2025 makes itemizing harder for households. That's why bunching several years of giving into 1 year, often via a donor-advised fund, can push you over the standard deduction in the bunch year. Then you take the standard deduction in the off years. Result: tax savings. Next, make sure your recipient is a qualified charity. Generally, you want a 501c3 public charity or private foundation. Use the IRS tax-exempt organization search to verify status, deductibility codes, and whether the charity is in good standing. Churches, synagogues, and mosques typically qualify even if they aren't listed, but documentation still matters. Gifts to individuals are not deductible, no matter how compelling the story. Most crowdfunding campaigns aren't deductible either unless the campaign is run by a qualified charity that issues proper acknowledgments. Political organizations and candidates are never deductible. Donor-advised fund sponsors, community foundations, and many universities and hospitals are qualified recipients. If you're unsure, pause before giving, check eligibility, and avoid learning at filing time that your donation produced zero tax benefit. Cash is great, but appreciated property can be even better. If you've held an asset for more than 1 year, think publicly traded stock, mutual funds, cryptocurrency, or real estate. Donating the asset directly to a charity generally yields a deduction for fair market value and avoids the capital gains tax you'd owe if you sold it first. That double benefit can stretch your giving power. Short-term assets, held 1 year or less, are different. Deductions are limited to cost basis. Some property types, like inventory, certain intellectual property, or tangible items used by the charity, have special rules. Crypto is treated as property, not cash. Transfers are doable, but documentation is critical. Ask whether the charity can accept the asset directly or use a donor-advised fund to facilitate. Know your deduction limits. For gifts to public charities, cash is generally deductible up to 60% of your adjusted gross income, AGI. Long-term appreciated property to public charities is usually capped at 30% of AGI. Gifts to private foundations are tighter, typically 30% for cash and 20% for appreciated property. If your gifts exceed a limit, you don't lose the benefit. The excess carries forward up to 5 additional tax years, subject to the same percentage caps each year. Ordering rules apply when you have multiple types of gifts. Example: if your AGI is $200,000 and you donate $150,000 cash to a public charity, $120,000 is deductible this year, 60%, and $30,000 carries forward. Careful planning prevents wasted deductions and aligns timing with your income nicely. Enter donor-advised funds, or DAFs. You contribute cash or assets to the DAF, get an immediate charitable deduction, and then recommend grants to operating charities over time. This is perfect for bunching. Contribute 2 or 3 years of gifts in one high-income year. Claim the large deduction now, and distribute to charities on your regular cadence later. DAFs also simplify giving appreciated securities. Most sponsors accept stock, and many accept crypto. Practical tips: start transfers early in December. Confirm the sponsor's instructions, and note that grants can't provide you benefits, no gala tickets or membership perks. Also, DAFs can't make qualified charitable distributions from IRAs, and they generally can't be used to fulfill a legally binding personal pledge. Think of DAFs as your philanthropic holding tank. If you're 70 and a half or older, qualified charitable distributions, QCDs, from IRAs are powerful. A QCD sends money directly from your IRA to a qualified charity, up to an annual limit indexed for inflation. For 2026, it is $111,000. The amount counts toward your required minimum distribution and is excluded from your adjusted gross income. Lower AGI can reduce Medicare premium surcharges, phase-outs, and taxation of Social Security. Benefits a normal itemized deduction can't always match. QCDs can't go to donor-advised funds, supporting organizations, or private non-operating foundations. They must be paid directly to the charity, not to you first. Ask your custodian for their QCD form, keep the acknowledgement letter, and report the 1099-R on your return with the proper QCD notation to document the exclusion. Documentation can make or break your deduction. For any cash gift, you need a bank record or receipt. For single donations of $250 or more, you must have a contemporaneous written acknowledgement from the charity stating the amount given and whether you received goods or services. Non-cash gifts over $500 require Form 8283. If total non-cash gifts exceed $5,000, you generally need a qualified appraisal completed before you file. This includes cryptocurrency. Publicly traded stock is an exception. No appraisal is required. Vehicle donations trigger Form 10098C, and your deduction is often limited to the charity's actual sales price. Quid pro quo rules apply to galas, auctions, and memberships. Your deduction is the gift minus the value of benefits received. Read the acknowledgement carefully before filing. Timing matters. For cash and checks, your gift counts when mailed by December 31st using the U.S. mail. Keep that postmark. For credit cards, the charge date controls, even if you pay the bill in January. Electronic bank transfers need to settle by year-end. Stock and crypto transfers can take days. Open the charity or DAF account early, verify delivery instructions, and initiate well before mid-December. Appraisals for non-cash gifts above $5,000 must be dated within the required window and attached appropriately to your return. If you're donating restricted stock or privately held interests, allow substantial lead time for legal review. When in doubt, shift to a DAF in December to lock the deduction, then recommend grants after New Year's without losing tax efficiency or impact. Small business owners, listen up. A C corporation can deduct charitable contributions up to 10% of taxable income, with a 5-year carry-forward for the excess. S corporations and partnerships generally pass contributions through to owners, who claim itemized deductions, and for non-cash gifts, owners reduce basis by their share of the property's adjusted basis, not fair market value. Here's the twist. Sometimes what you think is a donation is really advertising. Payments to a charity that prominently promote your business, logo placement, calls to action, links, or endorsements may be deductible as business expenses, not charitable gifts. Qualified sponsorship is fine, so long as the message is value neutral. Once you provide comparative language, prices, or inducements, it becomes advertising. Charities may owe unrelated business income tax on true ads too. Let's hit special rules and traps. Household goods and clothing must be in good use condition or better, unless an item worth more than $500 has a qualified appraisal. Vehicle donations are often limited to the charity's actual sale price. Get Form 1098C. Food inventory and certain inventory donations can produce an enhanced business deduction. Run the calculation with your CPA. State tax credits for donations can create big value, but federal rules generally reduce your charitable deduction by the value of the state credit you receive. Volunteer expenses are deductible when unreimbursed and directly related to services, mileage at the statutory charitable rate, supplies, and travel with no personal vacation component, not deductible. The value of your time, raffle tickets, or sketchy conservation easements today. Before we wrap, case studies. 1. A married couple planned to give $12,000 annually, but didn't itemize. They contributed $36,000 of appreciated stock to a DAF in 1 year, itemized that year, avoided $8,000 of capital gains, then granted $12,000 for 3 years. 2. A retiree with a 30,000 RMD used a 20,000 QCD and withdrew the remaining 10,000, dropping AGI, trimming Medicare surcharges and state taxes. Today we covered itemizing, qualified charities, cash versus property, AGI limits and carry-forwards, DAFs, QCDs, substantiation, timing, business sponsorships versus donations, special property, state credits, and volunteer rules, action plan, verify charity, choose cash or appreciated assets strategically, consider DAF bunching or QCDs, mind the limits, get the paperwork, and coordinate with a tax pro. Thanks for listening.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.